Right, so we're ready now. So what we said is that by Saturday, Sunday, when the market is basically resting, you go through the 28 pairs or thereabout, then pick the ones that are giving you some form of setup or close to giving you a setup. This strategy works best in a trending market. So you want to leave out those who are basically consolidating. You leave them out, and you periodically within the week go through other pairs that are not on your watch list to see if a breakout has occurred. If a breakout has occurred, then you can simply add it back to the list. And so these were the ones we looked at the beginning of the week. UJ has done pretty well. UJ has done pretty well. And like I said in the Telegram group, with UJ, GU, and which was that? I'd already done the target for the week, right? And EG, target of the week had already been done. So let's see UJ again. We looked at it briefly yesterday. Or look at it again today. Vis-a-vis our targets for the basic things we want to discuss today: Sharkfin, divergence, volume, with respect to the high of the day, the low of the day, or yesterday high, or yesterday low, or we look at quarters theory basically, right? So let's go to UJ. This was UJ. If you remember, let me call up one other broker, please. Call up Victor. Let's go call this up. Right. If you remember, we had just yesterday during our webinar, we said if this swing low, if if the trade is still going to continue on the downward trend, then we expect price to take out this low. We drew a line there, a horizontal line, that if the downtrend is going to continue, then we expect price to take out this low. And we said that's going to be our major target, right? We were looking at this block here. Price traded into it and we're going down. We said we should do 2R as our TP1. And we agreed that this point, I think we marked it up somewhere here. Let me see. We marked it up on one of these brokers, UJ. Let's see that quickly. We marked it up with one of the brokers. Right, so we're expecting, and price did just that today. Price gave us our main target for today. You know, meaning that this downtrend is still holds true. That downtrend still holds true. Now back to 15 minutes, we see this was where we got in from, right? We got in from here. This was the order block on 15 minutes. Price traded above it, gave us a breaker here, and we entered upon a retest. Our stop loss, if you remember yesterday, was like 19 pips. Yeah, so 20 pips. And it has given us so far, the low we're looking at was this low. We're looking at this low. Price gave us 142 pips. So let's take it as 140 pips for 20 pips SL. That is ratio 1:7. So if I had risked 2%, I would have made 14%. What's your weekly target? If I had risked 1%, I would have made 7%. And of course, if I have reached 5%, I would have made 5 times 7, 35. It all depends. Now, Sharkfin, we said we have 4 things we look out for to take our entry on the 15 minutes. We want to see price taking out yesterday high or low. And the reason why we're looking at yesterday high or low, and why we have this indicator on our screen, yesterday high or low, delineated by this light blue, or I don't know how to get that, I think that should be light blue, is because those are points of liquidity usually in the market. So you have yesterday high, yesterday low is the point of liquidity. Weekly high and low are also points of liquidity. And if you've been following SimplyPips for a while, we said, aside from fundamentals, what price does majorly on a normal day is that it seeks liquidity, right? It looks for where liquidity is and it attacks that position. So if you remember, we said at one point in time that both buyers and sellers are correct. If you come here and say price is going to go up, and some set of people say price is going to come down, both of you are correct, right? But we assume that there is a set of people or an establishment called the market maker. And the aim of the market maker is to make money. And if the aim of the market maker is to make money, it will go against the majority. So say we have 100 people, and by 100 I mean, let's say 100 million people in the market, and 70 million are assuming that price will go up, and 30 million are saying price will come down. The 70 million assuming that price will go up would have entered their trades either as limits or market execute. Ditto for the 30 million. What the market maker does is that even if he wants to come down, right, you first attack these guys who are buying. But the market maker is in the business to make money. He will attack these guys first, take them out. Then at a convenient price, he may now begin to come down. Right? So these guys who are proposing that price will go down are in the minority. So what will the market maker do? The market maker will actually go down so that these 70 million people will lose. When he gets to a convenient price after taking out these guys, he may now begin to find a way of going up. So let's say his initial intention was to go up, but it is not just going up just because price wants to go up. When you're in business to make money. For instance, presently, all over the world, there's a pandemic called the coronavirus. And the price of certain commodities are skyrocketing. Now, on social media, you hear a lot of people saying that we're doing bad. We're bad people because we're inflating the prices of things. It's not an issue of whether you are being bad or not. It's the law of supply and demand. When many people chase after few goods, the price will go up. Right? So what determines whether price goes up or not is demand. Right? People chase price. So the market maker will go against these guys. Right? Now, you and I are retail traders. We are not preview of what the market maker is going to do. We may look at our technical analysis and several other things and assume that price is going to go up, right, in line with our analysis. And that might just place us in the same bucket with the 70 million people, because we don't have any way of knowing whether we are part of this 30 million or not. We don't have any way of knowing. You are sitting down in your room, in your office, wherever you are, and you've analyzed and you decided to buy. You don't know if you are part of the 70 million or 30 million. You don't have any way of knowing that. Right? So how will I know that I'm against the majority? Because obviously, if statistics has it, well, everybody seems to be saying statistics. I've never seen statistics, but at least everybody is saying the statistics is that about 90 to 80% of retail traders lose money. And it's verifiable by just going through your community and look at how many people are actually making money from Forex, right? So if 80 or 90% of retail traders actually lose money trading Forex, it becomes very simple to see what I'm saying, that they will go against the majority. So it means the 20% winning are the minority. What you want to do at every point in time is become the minority so that you will perpetually win. You become the minority. How do we go about becoming the minority? Right? So some persons came up, did some research, or whatever I want to call it, and concluded that for price to move, there has to be a proportionate volume. And by volume, I'm talking about demand. There has to be a demand to push price. So if there is a way I can monitor demand, if there's a way I can monitor demand, and by this case I mean volume, then I might be able to monitor or predict when price will make a U-turn or where the market maker is planning to go to. Right? If you are a student of the Steve Morrow's method of trading, you usually see Steve Morrow saying that the second leg should not take out the first leg. So the market maker creates a false move up, which we call the vector move. It takes a breather. It comes back the second time and doesn't take out this move. But you see, when he was making this particular move, it will be usually it says three strong moves, impulse, which is a vector, and many retail traders will jump into this move. He peaks somewhere there, comes back, starts going up again, giving an impression that now I'm about to continue my move. More retail traders will enter into the buy. He fails to take out the first leg, then it drops there and moves. All the guys buying are now in disarray. That's what the market maker concept explains, right? Now, how do we do that using the strategy we're trading now? So come back here, and that's why we're introducing a particular indicator known as the TDI. Permit me to modify some things here. Properties. Let's make this pure white and make this other one white also. Right, so we'll have another webinar sometime this week, and I'll explain TDI in detail. And by explaining it, I will explain what these outer bands, the white lines, what they stand for. I will explain what this middle line stands for. Then we have a dark navy blue and something that looks like red. I will explain what all that means when we have that webinar. But for today, we want to look at volume. We want to look at volume with respect to TDI. Now, notice here that as price was making higher highs, showing that there is a demand for this particular thing here. There is a demand for, in this case, USD. the TDI is also making corresponding high. TDI is also making a corresponding high, showing that there is a correlation or an agreement within this, right? When the market maker comes into the market, what the market maker would do is that the market maker will initiate a false increase in price that is not supported by an increase in volume. So you would notice that price action itself will be pushing, in the case of a buy, price action will be pushing up, but your indicator, you could use different indicators, and that could be TDI, TDI, it could be RSI, it could be stochastics, it could be the normal histograms like that we would use, whichever one you want to use. For this purpose, we'll be discussing TDI. Right? So when price action is making higher highs and your TDI is reducing, making lower low, is an indication that the buy is peaking out. And even though you are seeing an increase in price, it is not supported by volume. There is no corresponding increase in volume. It could mean that the market makers are at work trying to fake out, give people an impression that price is on its way out, up, whereas what they really want to do is come down. Now, I have to explain this because I want to explain Sharkfin. Right? Now, it doesn't therefore mean that whenever we see price and TDI doing something opposite, that is enough signal to go in. You want to wait for price to do this manipulation around areas of liquidity. And we explained that the areas of liquidity we have is yesterday high or yesterday low, or the high of the day, which is basically almost the same thing. High of the day of yesterday will happen to be yesterday high, right? Low of the day of yesterday will be yesterday low, right? Then these special numbers like 00 or 05, let's go to a pair like UJ. Let's look at a pair like UJ. If you notice on my screen, you notice some horizontal lines. Notice that this is at 110.5. The next one is at 111.0. There's a difference of 50 pips between each of these lines. These are special lines. If I want to look for market manipulations, I want market manipulations to happen very close to these lines, this price, or at yesterday high or yesterday low. Now let's leave MT4 for a while and quickly use TradingView. I have an app here, an indicator here, right? I call it high and lows, right? You could high and lows. Let's go down to 15 minutes so you can see more clearly. Then let's also have our period separator so we could see the session breaks. Right, so these vertical lines here, the dash vertical lines, show a particular day. Right, so between this point to this is one day and the next. Now, I also want you to notice something here. The highest point on this day here, the highest price point happens to fall here. You would notice that that line coincides with the high here, with the dotted lines. These dotted lines shows yesterday's high, and the one beneath is yesterday's low. So yesterday's high was here at this spot. This was yesterday's high, and this was the lowest point yesterday, and that coincides with this. So you see, that's yesterday's low. That is why we have those dotted lines today. So what this indicator does is that it prints yesterday's high onto today's data feed. Yesterday's high printed into today's data feed. Yesterday's low printed into today's data feed. So let's look at the next day. The lowest point on this particular day is here, right? That's it. Lowest point. And look at how it's printed into the next day. The highest point on this particular day happens to be this spot here. I can see how it's printed. So I believe you've been able to get this. If you don't get it, please rewatch the recording again, right? So that's what yesterday high or yesterday low does. Now notice that if an average retail trader wants to go in for a sell around here, the stop loss will most likely be here. The stop loss will most likely be at yesterday's high, or this particular point, which happens to be yesterday's high for the next day, right? If a retail trader wants to go long at about this point, the stop loss will most likely be at this point here, and will be going long. This point happens to be yesterday's low. So when the market maker, or when price gets close to yesterday's high or yesterday's low, I want to now pay close attention to see if I can notice the handprint, the fingerprint, the footsteps of the market maker. If I don't notice any footstep and I can't explain what is happening, even if price is moving heavily like it did today on AUD/USD and price moved heavily, we simply sit out the trade. Like we discussed yesterday, you could have just 3-5 trades and you've met your weekly target. So we've had just 3 trades this week, and we've done about 25% of our account. So you don't need to have massive number of trades. You just need to wait until you can explain, or you can understand what is happening, and with a level of certainty predict what you think price would do. Would you get it right all of the time? No. But if it has an edge, meaning that if it happens most of the time, then you would grow your account and make money. So you want to wait for price, you want to wait to see what price would do at certain points in the market. And with that, I've been able to explain volume with respect to yesterday high and yesterday low. Now, remember, I said there's a strong correlation between high of the day, low of the day, with yesterday high and yesterday low, right? It's just that when we look at high of the day, we're talking about the highest point on the day, the date of reference. Remember, when we say yesterday low, we're talking about yesterday with reference with today with reference to yesterday. When I say high of the day, I'm actually talking about today's high. Now, we took UJ sell yesterday. When we took UJ sell yesterday, what we're looking out for was the high of the day. So we got let's go back to MT4 here. we said that we want to look for shark fins. Maybe I should explain shark fin first, then and divergence, then I'll now come back to UJ. So we have a shark fin if our signal line, which is this blue, closes above, goes outside the band. And by band, I mean this white curvy line. When price goes outside of it, we say we have a shark fin. I'm not good at drawing, but you could easily say that a fish will look at something like this, right? Then to have a fin somewhere there, right? So that this curvy move outside is what we call the shark fin, right? So we want to see this move. We want to see our signal line going outside the band, the volatility band, or the Bollinger Band, whichever way you're comfortable with, right? So we want to see price going outside it. When we see price going outside it, it means there is a vigorous move. And most times we assume that when price does this, that move may be fake. That move may mean that the market maker is just pushing price without corresponding volume. That is what we anticipate. We anticipate that price is pushed. So the market maker can't manipulate that part. Price may push up, which is what the market maker can do, but the market maker cannot hide volume, right? So price has pushed up above. We expect that price will come back down into the band. When we come to discuss TDI as an indicator, we'll explain what this middle line stands for, right? But just know that price will want to remain around this middle line as long as possible. And anytime there is a displacement, that is a disparity between that, price will want to gravitate towards the middle line. So we have this shark fin here. So that means we have a shark fin here. You notice we also have another shark fin at this point. We also have another shark fin here and one other shark fin here and this. So let's add TDI to our MT4, to our trading view. So we're going to add TDI now to trading view. We have TDI Traders Dynamic Index, that is TDI. Click on it. And now we have TDI on our trading view. Let's check out currency strength. And let's do some, let's clean this up a little. Color here, make it white. Make this white. Oh, default. Okay. Okay, I meant this plot background white. Plot background white. Okay. Let's make. All right. So we have our TDI now on our screen. Notice you have a shark fin here. Price going outside the volatility band, and price also goes outside the volatility band. So we want to see a confluence of certain indicators or certain happenings to make us make a decision as to whether to go long or go short. First, we want to see a shark fin. If we see a shark fin, that might be an indication that price will soon reverse, but that is not an indication to sell. Secondly, we want to see divergence. And by divergence, we mean that price action is doing something different from the indicator. So let's say this point here, you would notice that we're having higher high created here. We're having higher high. But notice what TDI is doing. TDI is making lower low. That is divergence. Remember we said when you see price action going upwards and TDI showing something different, that might be an indication to go short. So you see, we see divergence there, and price came down. Let's look for more examples of price divergence to explain this even further before we piece everything together. Look for examples of price divergence before we piece everything together. Let's go back to MT4. Put this down a little. Okay, here we have a good example. This red dot here indicates that price at this point is higher than the double wicks we have here. So in essence, what this shows is that price was making a higher high. But TDI was making lower low. Right? TDI was making a lower low, while price was making a higher high. That is divergence. It's an indication that there's every likelihood that price will want to come downwards. Right? Every likelihood that price will want to come downwards. So that is divergence. I believe I've been able to explain divergence, and I've been able to explain Sharkfin. If you want to do yourself some good, just go pick up a chart and do some markups yourself. You just have to show up, right? So let's go back to this point and continue the explanation we're trying to do. Very good. So this is the same spot we have on UJ on TradingView on MT4. Right, so price made a higher high here, divergence here, and we also have Sharkfin. I beg your pardon, and we also have another Sharkfin. But is that enough reason to go in for a sell or a buy? No, and that's why we have our major entry signal is that price must break the last step before the high of the day. In this case, the last step before this high was created happens to be this. And by the last step, I mean for a bullish move, the last bearish candle before the rally. For a bearish move, the last bullish candle before a decline. Right? So in this case, this was the last bearish candle before push up. The last bearish candle before the push up. Or let's even start with the very first one. Here we have a shark fin here. We have a shark fin right about this point. If I use this crosshair, you see it clearly that the shark fin coincides with this high. Right? So once I see that shark fin, the first thing I want to do is mark out the lowest candle, the last bearish candle before this push up. And I'm watching out to see if price will come back to take out this low. Is price going to take out this low? Price didn't take out the low. Price actually created a new high. So this used to be high of the day before. It's no longer high of the day again now. We now have a new high of the day. So our attention will now shift to the last bearish candle before the fresh high of the day. Our attention shifts to the last bearish candle before the fresh high of the day, and we'll be waiting for price to break beneath and close beneath this down candle. Right? Notice also how the shark fin coincides with that high of the day, but it never happened. Then it created another high of the day here. Now you notice on TradingView, it looks like this high here and this high here are basically the same, which is why I have another indicator here on MT4 that tells me that they are not the same, that the new high is, even if it's a point or a pip higher than this, making the new high the fresh high of the day. So my attention shifts basically from the blue high to the red high. And what was the last bearish candle before this red high was created? It happens to be this. So you simply mark it up, right? From week to week. Notice also that at that precise time, there is a shark fin here. Price closed, TDI went above my what? TDI went above my band. So here I have a shark fin coinciding with my high of the day. Remember, high of the day, low of the day, yesterday high, double zeros, double five. We're trying to pitch all of them together. So you don't just go and be selling anytime you see a shark fin. You just sell. No, you want it to happen at some points of interest. So price went above, TDI went above the Bollinger Band, which coincides with the high of the day. So I'm happy. Another thing is happening is that I'm having divergence. While price is making a higher high, TDI was making a lower low. So I have confluence of reasons to want to enter. Higher high, lower low, divergence. Then I also have shark fin. Good for me. Next point is I want price to break beneath. Price should break beneath the last step. And when it does that, we say last step has been broken. Right? So we waited for price to break beneath. So notice at this point here, price came beneath but didn't close. It went back into this rectangular box. But at this price, at this point here, where the cursor is, price closed beneath the box. Now I am willing to take a sell. So I put my sell limit at the close of that box and wait for price to do a retest, and I sell. My let's use this tool. So we are going short here. I will be going short at this point. We'll basically be going short at that point. Our stop loss will be the high of the day plus spread. So the high of the day in this case was like 18 pips. Say your spread is 2 pips. So that gives you 20 pips. Please mute out your mic. Mute out your mic, please. That gives you 20 pips. What's going to be our take profit based on this strategy? If you are twin trading, your first take profit is 2R. And by 2R, we mean whatever your risk is multiplied by 2. So if our risk is 20 pips here, then our take profit will be 40 pips for TP1. Right? So if our stop loss is if our take profit stop loss is 20 pips, as in this case, then our take profit will be 40 pips for first take profit, somewhere there. So we would have closed out this trade. So if you had reached 2%, you would have made 4%. If you reach 1%, you make that. Your second trade, you hold on to this trade until you are able to arrive at your take profit that would have been established on a higher time frame. Last week, we looked at some fair value gaps and some price imbalance that we expect UJ to go fill out. But while doing that, you also be trailing your stop loss. But today, we're not discussing trailing of stop loss. We're not even discussing take profits. We're just discussing, so we don't veer out, we're discussing shark fin divergence volume, right? So volume again, remember, as price is going up, I want to see a corresponding in growth in volume. When price is going up, but volume is dropping, it means that this move up might just be induced by a market maker to give a reflection that price is going up, but in the real sense, they want to come down. Let's discuss the last point on the first point we want to discuss, and that is 00 and 05. You'd notice, let's clean up this chart quickly. Clean this out and also hide this. Notice that price made this U-turn at what? A round figure 1.08.70. I want to see price turning out at quarter points. And by quarter points, I mean zeros, like in this case for UJ, 108.00 or 108.50, right? I just divide it in increment of 50 pips, right? Then I further break it into 25 pips. So between one, let's put a horizontal line there, here. That is, please mute out your mic, mute out your mic, mute out your mic. Somebody's mic is on. So we have 108. Let's say start from 108. If we add 25 pips each, then we'll get 108.25, another 25 pips, 108.50, another 25 pips, 108.75, right? 5. Another one will give us 109, right? So I want to see what will price do at those points. So this is 108.75 right there. Notice how price came close to it, even twice, and bounced back. So those are called hesitation points. The 50s and the 100s are the quarter points themselves. But the ones in between, the 25 pips, are hesitation points. So I want to see what is price doing at yesterday high, what is price doing at yesterday low, what is price doing at the hesitation points or the quarter points. Those are areas of interest for me. So when I have my chart, I want to have those horizontal lines signifying those points for me, so that in a glance I can see what price is doing. Now let's magnify this a little bit more so we could see clearly what I'm talking about. Okay, so we're here. Notice, notice I have a dotted line up there signifying 108.75. This line here, you see, half 108.75. You can see it written there, right? So I have several things telling me to sell UJ. Number one is close to my hesitation point. It is the high of the day. It has a divergence. It has a shark fin. It has broken the low, the last step before the rally. The only thing I have to do is just pull the trigger, right? So when UJ approached yesterday's high, which happened to be this point here, when it approached yesterday high, I begin to look for an entry signal. And I didn't get the entry signal all of this time until it came to this point. Now, the big question now becomes, so will I just wake up in the morning, come to my system, and spend the whole day waiting for all these things to pan out? And the answer is no. Right? The reason why many of us are embracing Forex is, it's been marketed to be something that can give us a healthy lifestyle, the type of lifestyle we want, that will have time for family, have time for religion, have time for several other things. So if we sit in front of our system from 8 a.m. till 10 p.m. in the night, Monday to Friday, it might not just be different from an 8 to 6 job, or is it 9 to 8 job, or whatever we call it, right? It might not just be different. So what should I do? When should I come to my chart? And that is what will take us to the last point here on point 3. We skipped point 2 for now. Kill zones. There are certain times of the day that price usually would move heavily. And I want to make myself available during those times, right? That time is called the kill zone. I'll use somebody's mic is on. I'll use another template to show us what the kill zone looks like. Let's wait for it to load up, load up, load up. Very good. All right, so here we are on, let's go to UJ. Where is UJ now? Okay, let's just take this for the purpose of this class. Now, presently, time on my system is 4:55 p.m. and time here on my MT4 is 6. It means my MT4 time is 2 hours ahead of the clock on my screen. So we use that to do an analysis. This red line here, underneath here, shows me the kill zone for London session. And the green shows me the kill zone for New York. Kill zone for London and kill zone for New York. It simply means that if I'm trading only New York and London session, I should have free time off my chart to do other things within the 24 hours. Here I have 8 a.m. on my MT4, which would coincide with 6 a.m. my own time as the beginning of the kill zone. Then I have 12 noon as the end of the New York kill zone, which will coincide with 10 a.m. my own time. Then New York kill zone starts at 1400, which will be like 12 noon my own time, and will end somewhere around 1800, that's 6 p.m., which will be like 4 p.m. my own time. So I have 4 a.m. London session, and 4 hours within the London session, and 4 hours within the New York session, standing as my kill zone. So I have an 8-hour window with which I could come and see what price is doing and make my decision whether to go long or short within this time. And still, I still don't have to come back or stay on my system the whole of the 8 hours. If I'm trading GA, for instance, it would be wise to focus on the London kill zone alone, because GBP is a London-based pair. I should just focus on London session. That's with the assumption that I'm not trading during the Asian range, which is delineated by this blue line. I'm not trading the Asian range. I'm only trading the London or the New York. So if I'm trading GBP related pair, Euro related pair, I want to come to my system during the London session. If I'm trading CAD and I'm trading USD, I want to be on my system during the New York kill zone. If I'm trading some pairs that have a mixture of both, like GU has both GBP, which is a London pair, and USD, which is a New York related pair, right? Then I could be online during the London kill zone and also the New York kill zone. What this does is that it helps you catch some move, and you don't spend the whole of your day on the system. Would you miss some moves? Yes, you would miss some moves, because there might be some moves that might happen outside of the kill zone, but they are not, that won't happen frequently. It won't happen frequently. So let's look at GU, for instance. We are on GU presently. Say you wanted to go long on GU. The long move actually started during the London kill zone. The long move started there. Say you had wanted to go long again the day before. The long move itself started here during the London kill zone, right? Say you want to go, say you wanted to go long on this particular day. Your long move actually started at the London kill zone. Then you had a re-entry at the New York kill zone. So if I was awake and on my system between this point and this, I might not have caught much, right? Next day, say you wanted to go long on this particular day. The long move started London kill zone, and it remained all through, right? Say you wanted to go short on this day, or say you want to go long. London kill zone, you had an opportunity to go long. If you wanted to go short, the short move started in between the London kill zone and the New York kill zone. You would have missed this first move. But if you have a strategy to give you an entry, you could have had an entry in your New York zone. In fact, if we're to trade this pair using our strategy, we had the high of the day here. Uh-oh, I guess my lines are white. Trend line properties, let's change it to blue. Great. So we have the high of the day here. Magnify a little more. So we have the high of the day here, which was the last bearish candle before the high of the day. We mark it up as our breaker, as our last step. The price trade beneath it. Yes, price traded beneath it here, right? Then we have our sell limit at that point. Let's make this red so it could show even more clearly. Right? So say you wanted to go short and you came on your at New York, you simply see that price had created a breaker and you'll be anticipating a pullback for you to sell. And that's exactly what happened. You'll be anticipating a pullback and you sell. Why will I anticipate a pullback? Why will I anticipate a pullback? That takes us to the last thing we want to discuss before we close: gaps, right? I explained previously that when price is moving either up or down, you want to have a reference candle, then you have your A and B candle. In this case, we'll be having this bullish candle here as our reference candle, right? Then the candle to the left is my A candle, and the candle to the right is my B candle. I want the wick or the body of my A and B candle to intersect. In this case, there was no intersect between the body and the wick of my A and B. And because there was no intersect between A and B, the gap between A and B becomes a gap I'm anticipating price to come back to fill, right? The way price behaves is that it tries to cover all the gaps. So take this as your reference candle. Say take this as your reference candle. What I want to see is that the lower wick of this bearish candle and the upper wick of this candle have some form of intersect, which actually happened. This candle pushed into the body and the wick of this, so there is no gap here, right? To come back to this candle, say this is our reference candle. Let's take this to be our reference candle. You will notice that there is a gap between this candle and this. There was a gap here, right? I would be expecting for price to come back and fill that gap. And that's exactly what price did. Price came back, filled that gap. That is my entry. And it fell off from there, right? Now, I did all this analysis within my kill zone. So even though the descent started in between New York and London kill zone, I was taking a nap. You could be taking a nap. You could be doing something else. You could be reading a book. You still did not miss the majority of the move. Your stop loss from entry to this point was going to be 50, 60 pips, and your take profit to be 120, and it gave it to you. The price did 270 something pips that day. You had your 120 pips, and you're out of the market. You are safe. So that way, you don't spend the whole of your day in front of the chart. You only come out like a sniper when it is actually necessary to be around. Again, I repeat, will you miss some trades? Yes, you would miss some trades. Every trader misses trades, and you just simply let that slide by. So I'll be posting this on YouTube and hope that you can go back and watch. I'll pause the recording now, and we can now discuss your questions. Give me 1 minute.